Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, insurance, loans, real estate, and everything else to do with your money. We, of course, would love to hear from you, so please feel free to write in with your questions and your queries, and we'd happily take that up with our experts. First up, it's time to take a check of the top headlines this Friday evening. It's earnings season galore. SBI released its second quarter F525 earnings. It reported a 28% year-on-year jump in net profit at 18,331 crores against 14,330 crores. The net interest income also increased 12.32% YOY to 1.14 lakh crores, while net interest grew 5.37% year on year to 41,620 crores. Net interest margins of the bank reduced marginally by 15 basis points YOY and 8 bips on a quarterly basis. SBI's gross NPAs have also improved by 4.14% in the second quarter of the current financial year. The bank said it has received approval from its board to raise long-term bonds worth 20,000 crore rupees through a public issue or a private placement in the current financial year. Next up, the Supreme Court yesterday ordered the liquidation of Jet Airways. The airline's insolvency process finally came to an end when the court rejected a bid to take over Jet Airways and instead decided to sell off its assets. The total book value of Jet Airways' assets is estimated to be about 1,000 crores, which represents roughly 13% of the money owed to its creditors and 6.5% of the total claims against the airline. However, if these assets are auctioned, they're likely to fetch only 50% of their book value. According to reports, Jet Airways owns non-core assets worth 1,066 crores. Amongst the most valuable non-core asset that Jet Airways owns is a 15,000 square foot building in Mumbai, which is valued at 683 crores. Additionally, it does own an aircraft, Boeing 777-35, as of June 2019, which was valued at 376 crores. Along with that, it does own smaller land parcels all over the country. Well, it's gold, gold, and gold. Global finance physically backed ETFs of inflows for the sixth consecutive month in October, making it the first time this year that year to date flows have now finally turned positive, largely coming into North America and Asia. In October alone, gold backed ETFs attracted $4.3 billion in inflows, raising the total holding to 3,244 tons. After 3 years of outflows, mainly due to higher interest rates, the past 6 months have seen a significant reversal in trend. With continued inflows and rising gold prices, global assets under management in gold ETFs stand at a record $286 billion at the end of October. But the big story today was the Federal Reserve, as expected, cut rates for the second time this year, down by 25 basis points. Fed chief indicated that the economy is in good stead and inflation is under control, and also indicated they would monitor economic data before deciding whether or not to implement the last rate cut of the calendar year 2024 in their December meet. Back home, the rupee continued its downward trajectory, dropping to a new record low. The rupee opened at 84.32 against the dollar and later fell to close out at 84.37. Well, that of course were the big headlines this evening, but the big interesting conversation lined up for you today, and it's all about your money, like we said. So, the big debate that I often come across is diversification versus over diversification. Why is it important to have the most optimum level of diversification in your financial portfolio? To take this conversation ahead, we have with us Harsh Roongta, partner at Fee Only Investment Advisors LLP. Hi, Mr. Roongta. Thank you for taking out your time to talk to us this evening. Mr. Roongta, this is actually, let's talk about the last headline that I took our viewers through. The Fed has lowered interest rates. There's a whole belief outside that the new president, Trump, will have policies that are inflationary, which also means that the rate cycle in the US will slow down. But independent of that, the anticipation is that the RBI will cut rates as early as Feb. Keeping in mind a potential rate cut in India, what is your view on the rate cycle and on debt funds as whole? Do you think now is a good time to maybe add some duration to one's portfolio tactically?
So, I mean, I think the question is with reference to that portion of your investments that are allocated to debt. Okay, and I think that's the portion that is most affected. Of course, everything is affected, but that's the portion that's immediately affected. And I'm not ducking your question, but basically, as far as debt is concerned, our view is that uh, debt is meant as a balance towards the other volatile assets that are there out there, whether it is Indian equity, international equity, whether it is gold. So when you're using something as a balance, okay, I think the steadiness of that balance is very, very important, and therefore really trying to uh, time that through either taking more risks on it through credit, or trying to time the duration, taking a longer horizon if you expect rates to drop, and taking a lower horizon if you expect rates to increase. Maybe you can do it, and maybe it can add a few basis points. But if your end purpose of using that debt or fixed deposit portion of your investment basket is concerned is primarily balance, I think these things should not matter. To answer your question, I think clearly that Indian markets have priced in the Indian fixed income markets, the debt markets have clearly priced in the fact that there will be rate drops going forward. So maybe if you're looking at a debt allocation alone, standalone, not as a stabilizing factor, maybe it is time to add duration, as you said, because if the rates drop, then uh, you can expect to make some money. I would be very hesitant to increase credit risks at all.
Okay, fair point. So I agree with you. The role of debt in an individual's portfolio is got to be of balance and sort of limiting the downside when equities turn volatile. And one should always look at this not so opportunistically, because for that we have equities. But like Mr. Roongta said, if you do want to add debt tactically and not strategically, now may be a good time for the next 18 to 20 months. If you do get the anticipated rate cuts, you could stand to generate a little more returns or higher returns than what you're currently getting on back of the yield movement. But let's come back to the most important conversation. And I think the more we talk about it, the lesser it is, right? And it's all about asset allocation. I want you to start by telling our viewers, how does one determine their ideal asset allocation? Very casually, we talk about how it depends on your age, on your objectives, on your cash flow. But sum this down for us. How does one sit around, and of course, easier to do it to a financial advisor, but if not, how does one determine their ideal asset allocation?
So I think one thing to understand is that there is no one ideal asset allocation. It will be different for different persons, and even for that person, depending on the situation, it will change over time when the circumstances change. So what are the factors that will determine it? Obviously, the biggest factor that will determine is what will you use it for. What is the goal? What is the objective? This investments that you are making, what will they be used for? When they will be used for? How much will they be used? What is your own risk profile? you know how comfortable are you with looking at downsides, and do you tend to panic easily, uh, or even handling upsides? I've seen people panic even with upsides. So downside panic is understandable, but I mean it can happen on both sides. The third thing is how much resources are available. So if I was to just give an sort of a travel analogy, A lot of the commentary in social media everywhere is, oh, this scheme is good, this product is good, and then you do a collection of products, and that becomes a portfolio. And I think that is like putting the cart before the horse. uh, you first need to decide what are the, so if you're doing traveling, you can't decide the mode of travel. Okay, I'll go by plane because it is the fastest, or I'll go by rail because it's very comfortable and I love traveling by rail, etc. You first need to decide where you will go. Then you need to look at what are the various alternatives that are available. Do you have the resources for that? What are your personal preferences? So somebody who has the resources and somebody wants to go fast, but if he has fear of flying, he may not really be able to fly. So I think everything in an investment portfolio, what do you want to achieve, when do you want to achieve that, what kind of risk you are in a position to sort of take, what resources you have available, I think that will broadly determine in what kind of investments or asset allocation you will do, how much you will put in fixed deposits or slow slash debt, how much will you put it in equity, international equity, gold, if it's big enough, maybe real estate, if it's even bigger, maybe alternate assets. So it really depends on person to person. There is no real single rule.
Okay, nevertheless, once you have your asset allocation in place, which is dependent on your objectives, your cash flow, your corpus, that is step one. Step two, then, I believe, is getting a strategy in place. So let's start with the strategy around equities. And maybe you want to tell our viewers what is the sort of strategy one should adopt? Should it be market size driven? Should it be core versus satellite? Should it be passive versus active? And then, of course, we'll talk about products. But let's take a look at equity mutual funds and what is a strategy one should ideally be adopting.
So I think it is important to understand why do we do diversification, right? So every investment basically only three parameters, right? Risk, return, liquidity, and diversification is basically to reduce risk. And I think all of us know that risk, return, and liquidity are inversely related. So if you want low risk, it will come accompanied with lower return. If you if you want high returns, it automatically comes accompanied with high risk. And if you're willing to compromise with liquidity, you would expect a little bit of a kicker in your returns, and vice versa. So the point is that diversification, if it is meant to reduce risk, I think we must understand that it will lead to a potential reduction in return. And I think the skill in diversification is to try and minimize that reduction in return, which is inevitable, uh, but still reduce the risk to the extent you are able to. So I think it's an optimization exercise. And that optimization, even if say we restrict it to equity funds, for example, although a better diversification is across asset classes, and one of the best diversification is it multi asset funds, or funds that automatically rebalance. It's a very very powerful concept, where you have decided your asset allocation. You can choose a passive fund that mixes this in that same proportion that you want, and it automatically rebalances. So it takes away the one issue with rebalancing, which is greed and fear, because it is happening outside of your own sight. uh, it's a very very powerful tool, of that across asset classes is a very very powerful tool. But even if we, let's say, stick to equity, diversification can be of many many forms, as you mentioned two or three of them. You can do it based on goals. So you can decide that, okay, I want to take relatively lower risks with this portion of my equity portfolio, let's say, because this will cater to something that is absolutely important to me. Okay, so I want to take relatively lower risk, and I understand that this will lead to relatively lower returns. So that can become your core portfolio. So that Relatively lower risk can come. You can do it cap wise. You do large cap, it is relatively lower risk versus a mid cap or a small cap. uh, or you can do passive versus index, that or passive versus active, where you're not taking a fund manager,
Right,
additional fund manager risk.
right,
So there will be multiple ways in which you can sort of do this diversification.
right,
But a preferable way is something that self balances on its own. That really is
right. So
something that we.
what I'm taking away from what you're saying, Mr. Roongta, is first up, diversification should be at an asset level, which was what we started this conversation with, right? About equity, debt, maybe some gold, maybe alternatives, maybe a geographical diversification. Level two is what I wanted to understand is diversification at a portfolio level, which you also tried to highlight for me. But what I want to completely get to the bottom of is very often, I mean, and you'd agree, you'd have clients who'd come to you with hundreds of mutual funds. And over a 10-year period, these funds have underperformed the benchmark. And I think most often I land up saying is that if you own the market, there's no way you're going to outperform the market, right? I mean, it's simpler to just buy the index and to manage 100 funds. So, in that context, how many funds do you think are too many on one asset class, which is equity?
So, I mean, again, to give a number, I know people want to look at a number, but it's very difficult to have a pat
No,
answer to a
sir,
question.
do you think having over 20 plus funds is a good idea?
So I don't think so. I don't think that would be really be indicated in any situation. Basically, okay. So I've had clients with 118. I have one client I
Yeah.
remember who, when he came to us, he had 118 schemes. Okay. And it was not a huge portfolio. So I mean, and when I asked him why did he do it, so it was not done consciously. I mean, he would just buy whatever sort of came to his
Somebody sold to
fancy.
him.
Somebody told him, he would look up on the web and just buy. There was no system at all. So that is not diversification. As you are saying, you are buying the market, and you, if you want to buy the market, buy the index. At least it comes at a low cost.
The
You're
cost. Yeah.
buying the market and you're buying it at a high cost. You're bound to underperform the market effectively. So if there is so much overlap, so remember, diversification is to reduce risk. But if you're diffusing the risk, and that too at
Product
such a high
level.
cost,
Yeah.
okay, it will make no sense. So much better would probably be that you do what we you mentioned, that you probably diversify in terms of caps, okay, or maybe as a core and a satellite. So you can do core, can be passive. Within passive, you can again do large cap, mid cap, small cap, mid and small cap, large and mid cap.
So, in
You know,
each category, Mr. Rungta, would it be fair for me to assume that one to two products would be enough? So, assuming we are going with market size, you go large cap, mid cap, small cap. So, in large cap, maybe two strategies, mid cap, two fund managers, and small again, two. Would that be sort of a good way
I
to look
think
at it?
one
Because
one
otherwise, you're
would
just
be.
populating your portfolio with products.
So one of our guiding principles is consolidation. You want number of line items that you look at
Yeah,
should be reduced, especially as you age, right? You don't really want too much scatter, and it does not matter how big the bottom line is. So I think more than one in a particular slot that you have made needs to have a very good reason. So if it is a small cap, I can maybe understand that the overlap will be very low. Okay. So maybe if the amount that you have allocated for small cap is very large, as per whatever is your definition of large, maybe you break it up into two. Otherwise, I don't see a
not
reason
required.
why there should
So,
be
I
more
think
than
I'm
one
going to,
for a slot.
yeah. So I'm going to conjure from what you're saying that five to seven would be a good number of funds to have.
I'm a
Now,
little hesitant to give a number. I mean, because it depends, right? Because 5 to 7 in equity, let us say, okay,
yes,
then
yes,
you
that's
might
correct.
have
We're looking at
international
equity
equity.
independently.
You might have, gold. Gold, of course, is a single asset class. So, I mean,
Hmm.
yeah.
So in equity, yeah, under 10 is what I think we'd like to see. And like Mr. Roongta said, you may want to add one or two maybe in the large cap space, but in a small and mid cap, one is probably more than enough. So keep the list short. I think that's one of the most important pieces of advice. The number of light items should be few. That keeps your cost in control. It also prevents over diversification. And remember, if you're over diversified, you cannot generate a significant beat to the Nifty itself. My second question then is once you've got the products in place, how and where do you sort of then keep cost in mind? Why is cost such a significant part of portfolio building, and how do you keep that under check, Mr. Rungta?
So I actually, we don't really look at costs. I personally feel that people focus on costs, okay, because it's an easy thing to focus on. It's an available. If you're looking, let's say mutual funds, and so you know the cost. This is the total expense ratio. Now, I've seen people decide index funds, for example, on cost. Why should you decide index funds on cost? I can't see the rationale for it at all. If I have decided to buy a particular kind of market, a particular index, and if multiple index funds are available, let's say, or ETF,
Yes,
ETFs is a
yes,
separate example. If multiple index funds are available, for example, I would choose the one that has most closely replicated the index over a
correct.
period of time,
Tracking
right?
area has to be
Yeah,
low.
tracking more than tracking error. I think the tracking difference, okay,
Should be, yeah,
is what we would look at, and even tracking
correct.
difference, I would not do one time. Okay,
You
so
track it over a
tracking
period of
error
time. Yeah,
over a period of time.
yeah,
Okay,
fair point.
because that's what I care about. And we're talking
Right.
equity index. If it over 3 years, even if it charges more because of whatever strategy the fund manager,
As long as a high cost comes with high return, we are comfortable, is what
not
you're
high
saying.
return closer
In
to the
line
mean.
to the benchmark. Right. Mr. Rungta, again, this is again a belief that I feel a lot of people would probably land up thinking. And I know the answer to it, but I want you to tell our viewers why you believe what you believe. Do you think the number of funds should increase in line with your corpus increasing?
Not at all. Not at all. I don't think it should matter at all. And this, I mean, at whatever level each one of us operates, and people come with this assumption. Okay. So this is the point that I make to some of our clients, say, who want to put money in AIF. Okay. And I'm just picking that example because if you look at most AIFs, it's high risk, low liquidity, and therefore your expectation of return is high. Now you have allocated a certain amount of money to that AIF, okay, for that kind of a risk and liquidity parameters with a certain return expectation in mind. Why would you then go out and then sort of diffuse that, okay, uh, over say four AIFs? I can understand maybe two, okay, and especially if the amounts are, let's say, very very large relative to what, and somebody who's putting in AIF, the amount is, his overall portfolio is likely to be high. But again, diffusing it, then why put in AIF itself? If you want to reduce the risk, why not downshift it to a more aggressive mutual fund? Because that's what effectively you are creating by taking more than one or two AIFs. So this penchant, because your amount is large, and therefore let me you know break it up, might as well put it in the mutual fund. That is the best vehicle,
Right. So make more concentrated bets and top up on existing funds if the
at least for
corpus
that
increases.
portion where you are
Right.
anyways taking risk.
Right, sir. So also another aspect I want to talk to you about, and like you said, right, there'll be a new NFO, a banker will come and sell you a product, you will invest in it, and you sort of keep doing that, and that makes sure that your portfolio manages to have so many products in it and so many funds. Now, I think one rule that I think works is when you buy or invest in a new product, it should come at the cost of another product. What I mean is, if you're making an entry into a new investment, maybe you want to exit an underperformer. Unless there is enough reason, just simply adding funds is not always a good idea. Would you agree with me, or you think exceptions can be made?
Oh, totally agree. I mean, so my point is, if your entire value system is that you do it by asset allocation, okay, but now you come across a product, your friend, family, somebody recommends this product is good. Client comes to you and asks, "Ye kaisa, how does it look to you?" And you say, okay, which slot are you going to put this in? What is there in the existing slot there? Okay, so there is no space in that for more. Either you take that out, or I mean, you put this in, right? So there has to be a reason why this will replace that other one. Either you are unhappy with what is there. What are the criteria you have set for it being unhappy? Because performance evaluation by itself is a uh, whole thing by itself, especially in the high risk class, because over what period will you see the risk play out? And when will you become unhappy? When should you become unhappy? Should you become unhappy with a class cricket player because he has not done well in one test, he's not done well in one series, he's not done well in two series? Okay, when do you decide that somebody is that some particular product is not performing and needs to be replaced? In which case it should be active. You should not wait for a fresh product to come along to replace. If something is not performing, you better have looked for a replacement yourself. And if at that point of time something comes along that is suitable, along with other contenders, that should be put in line. Why should only that one contender, because it happened to be present at that point of time,
Right, sir.
just be allowed the privilege of being a challenger to the existing emperor? I think the list of challengers should always be pretty high, because as they say, no, a rich man and his money are invited to every wedding in town.
Mhm.
So will you go to, just go to the first guy who invites you, or you will choose who you want to go to? I think it is up to the investor to decide.
Right. So, Roongta, of course, we've tried to simplify this for the viewers, and I'm just going to wrap this up and take up the questions that we have. But like Mr. Roongta said, your asset allocation is most important, but that's dependent on you. It's not a cookie cutter approach. So, depending on what your objectives are, what your age is, what your risk taking ability is, that will determine asset allocation. When we talk about diversification, diversification and asset level is most critical. Equity should be used to generate and create wealth, while debt should be used as an instrument to strategically balance and provide the cushion when equity markets turn volatile. Thirdly, do not over own the market, because if you own more than the market, there is no way you're going to beat the Nifty. An ideal number of products in a portfolio should ideally not exceed 7 to 8, because it doesn't really then serve the purpose of managing risk and improving your returns. Well, that is the net conversation of it. And also, every time you make way for a new product, an old product should be making a way out. Because if the old product is serving the purpose of generating returns and managing risk, there is no reason for you to add an additional product to your existing portfolio. Keep your line items few, keep your cost in check, simplify instead of complicate. I think that's the most important piece of advice we can give you. Also, if you don't have the ability to diversify on your own, maybe a balanced or a hybrid or a multi asset fund could potentially be a good idea, because that will do it on your behalf in so many ways. But quickly, let's take up questions, Mr. Rungta. Uh, I'm going to go with Charmi Kadaki, and she says, how can I find the right balance in diversification? I think we've answered most of it, but if you want to quickly add another line to that, would be great.
So I think how do you find the right balance in diversification is, I think you need to know the purpose why you are diversifying. The real purpose of any diversification is risk reduction. That's my view,
That's
right?
pretty much.
So if it is risk reduction, I think the real balance lies in understanding that any reduction in risk is going to result in a reduction in potential return. I think understanding that will lead to a good balance. because end of the day, you can't expect the same return with a diversified portfolio that you can expect from a potentially concentrated portfolio. So as long as I think you understand this trade-off, you will arrive at a balanced portfolio.
Right. Also, Vineet Patel asks this, and he says, what does it mean for gold ETF demand to turn positive, and how could this impact my investment strategy? So, Roongta, I think I'll take that because that was one of the headlines. Uh, Vineet, I think it's an important to know, not necessary to execute. One thing you want to know is that gold demand has been on the up move in anticipation of rate cuts, which the Federal Reserve has already started undertaking. What we also know, which is important to note, is that the last time Trump was in the White House, gold prices declined. So you want to watch out for it. Gold has had a very beautiful run year to date or in the last 1 year. It may be time to start booking a little bit of profit on gold only because looking ahead, if the number of rate cuts do reduce, the journey of gold on the upward trajectory may also come off. But of course, this comes in the disclaimer. You should be talking to your financial advisor and getting his view on this as well. The next question we have, Mr. Roongta, is from Nidhi Singh. And Nidhi says, what are the signs that my portfolio may be too over diversified?
Again, there can't really be one answer to this without knowing the. It's the too generic a question to be answered. I
I
mean,
think,
you answered it in parts in terms
yeah,
of
yeah,
the number of schemes and number of
yeah.
line items.
Nidhi, if it gets too complicated to manage and if you're investing in that every next NFO that is opening in the market, you know your portfolio is over diversified. Also, what you want to remember is if you're not being able to generate significant returns, despite, of course, the benchmark doing okay, and your products, one product at a time doing okay, then you know that it's not having a material impact on returns. What I mean is that making small allocation on the tail end of your portfolio will not have a material impact on portfolio returns. So you want to track portfolio returns, not product returns, and an ideal number of funds should be really in that 7 to 8 range at best. Well, Ashish also writes in, Mr. Roongta, and he says, how will the Federal Reserve's interest rate cut affect my investment portfolio, especially the ones that I'm holding, which are US based assets?
I think you could answer that much better than I
Yeah,
can.
so I'll attempt that, right? I mean, Trump's policy, which is called "Make America Great Again," I think that's the line that's doing the rounds, which is MAGA, is expected to be positive equity markets because he's talking about cutting taxes and implementing tariffs. So if you've got US equities, and he's talked about energy as well, which also means manufacturing, communication, could be sectors that could do well in the US. So if you've got an equity portfolio which is based on US stocks, then you're in positive territory. The trajectory does look good because corporate profitability will improve with a cut in taxation. On the debt side, the view might be divided because, like I said, while the Fed has given us the rate cut that the world was watching for, do not forget that Trump's policies are going to cause inflation because if you're going to put tariffs, interest rates will have to be moved up as inflation will increase, which also means that the yield on the 10-year will be impacted and the gains on your debt portfolio may not be as significant. So in the US, for assets, equity positive, debt potentially negative in the next few months is what I seem to believe. Crude as well as an asset you want to watch. Trump likes black gold, like he said. But if he increases production of US shale, which is what he's pushing for, it only also means that crude prices will remain under check. So I hope we've tried to answer these questions. But thank you, Mr. Roongta. Thank you for watching us. Thank you for
Thank you.
joining us this evening. Mr. Roongta, always a pleasure.
Thank you.